Americans forfeit an estimated $3 billion in FSA funds every single year, not because eligible expenses did not exist, but because there was no plan. This content is for educational purposes only. Always consult a qualified financial advisor. Here is the complete strategy for 2026. You enrolled in your FSA. You contributed money throughout the year. And now you have a remaining balance that needs to be spent before a deadline that is closer than you thought. You are not alone. Americans forfeit an estimated $3 billion in FSA funds every single year. Not because the money was not available, not because eligible expenses did not exist, because there was no clear plan to spend it in time. The reasons are consistent. Some account holders forgot they had a balance until a notification arrived in November. Others believed only doctor copays and prescriptions qualified, unaware of how broad the eligible list actually is. Some overfunded at enrollment. Others panic spent in December on ineligible items and lost the money anyway. Every forfeited FSA dollar was earned income. You already paid to earn it. You contributed it pre-tax to reduce your tax burden. Losing it to forfeiture means you paid taxes on money you never got to use. This video gives you the complete strategy, your deadline, your spend target, your eligible categories, and a system that prevents this from happening again. Before spending a single dollar, confirm your plan's deadline structure. This determines your entire strategy. There are 3 possible structures. Your employer can offer only one. The hard deadline funds must be spent by December 31st. Any unspent balance is forfeited completely on January 1st. No extension. No rollover. This is the most common structure and requires the most urgent action. The grace period, your employer extends the spending window by 2.5 months, giving you until March 15th of the following year. This is not automatic. Your employer must have elected it. More time is available, but a March deadline arrives faster than expected. The carryover up to $680 of unspent funds rolls into the following plan year. Anything above that amount is still forfeited at year-end. The carryover reduces, but does not eliminate urgency. Your employer can offer only one of these 3. Some offer none. If you do not know which applies to your plan, call your HR department or FSA administrator before doing anything else. Every decision in this video depends on knowing that answer first. Once you know your deadline, calculate exactly how much you need to spend. Spending without a target leads to either leaving money forfeited or panic buying items you do not need. Start with your current FSA balance. Log into your plan portal or FSA debit card app and get the exact number, do not estimate. Next, subtract any upcoming known expenses that will naturally draw down your balance. Scheduled appointments, prescription refills already planned, dental work already booked. These spend themselves. What remains after subtracting known expenses is the gap you need to close intentionally. If your plan offers carryover, subtract up to $680 from that gap. That portion survives into next year. You only need to spend what is above $680 by December 31st. The number you are left with is your true spend target, the precise amount you must spend on eligible purchases before your deadline. Write it down. Everything from this point forward is a plan to close exactly that number. Not more. Not less. Knowing it prevents both forfeiture and unnecessary purchases. The first spending category is stocking up on over-the-counter health items you already use. This is not wasteful. You are converting future out-of-pocket purchases into pre-tax FSA dollars before they expire. Since the CARES Act of 2020, over-the-counter medications no longer require a prescription to qualify. This change is permanent. Pain relievers qualify: acetaminophen, ibuprofen, aspirin. A 12-month supply purchased now means 12 months of that expense paid from pre-tax dollars. Allergy and sinus medications qualify. Cold and flu treatments qualify. Antacids and digestive aids qualify. Sleep aids qualify. Antibiotic ointments and antifungal treatments qualify. First aid supplies qualify: bandages, gauze, antiseptic wipes, cold packs, heating pads, thermometers. Sunscreen with SPF 15 or higher qualifies. Stock up for the full year ahead. Feminine care products including tampons, pads, menstrual cups, and period underwear have been FSA eligible since the same 2020 expansion. Nicotine replacement therapy products, patches, gum, lozenges qualify where applicable. Buying a full supply of items you use regularly is exactly the kind of efficient pre-tax spending this account was designed for. The second category is scheduling medical appointments that are already planned or overdue. This is the highest value use of a remaining balance because you are spending on healthcare you actually need. Dental cleaning. If your next cleaning falls in the first quarter of next year, move it forward before your deadline. The appointment, x-rays, and associated lab work all qualify. Eye examination, annual exams qualify fully. Prescription glasses, contact lenses, and prescription sunglasses all qualify. Annual physical, your primary care copayment qualifies along with any associated lab work. If you have been delaying your checkup, schedule it now. Dermatology, annual skin checks are a frequently overlooked eligible visit. Book one before your deadline if you have not had one this year. Mental health sessions, therapy, and psychiatry appointments are fully eligible. Move sessions into your current plan year where scheduling allows. Physical therapy for any diagnosed condition qualifies. Specialist follow-ups you have been delaying qualify. You are receiving care you needed anyway and timing it to align with your FSA deadline rather than your convenience calendar. That is what strategic FSA planning looks like. The third category is medical devices and equipment, higher ticket eligible items that can close a meaningful portion of a remaining balance in one or two purchases. A blood pressure monitor is fully eligible and useful in virtually any household. Typical cost is $30 to $80. A pulse oximeter qualifies. Glucose meters and test strips qualify. Digital thermometers qualify. Hearing aids are among the highest value FSA purchases available, fully eligible and ranging from $200 to over $2,000 depending on type. If a household member has been delaying this purchase due to cost, an FSA balance is a legitimate opportunity. CPAP machine supplies qualify fully, masks, filters, and tubing for diagnosed sleep apnea. If supplies are due for replacement, now is the correct time. Prescription eyeglasses qualify. A backup pair or updated prescription is a fully eligible purchase. Prescription sunglasses also qualify. Every item in this category shares the same characteristics. Genuinely useful medical products. Clearly eligible with no gray area. And each can absorb a meaningful portion of a remaining balance without requiring multiple small purchases. This is where panic spending causes the most damage, and the ineligible list is just as important as the eligible one. When account holders realize a balance is about to expire, the temptation is to spend on anything health adjacent. This routinely produces rejected claims, required repayments, and sometimes deactivation of the FSA debit card. Vitamins and general supplements do not qualify, even if a doctor has mentioned them, even if sold at a pharmacy. General wellness supplements require a specific diagnosis and prescription. Gym memberships do not qualify without a letter of medical necessity tied to a diagnosed condition. Purchasing one at year-end without documentation will be rejected. Teeth whitening kits do not qualify. Cosmetic. No exception for year-end urgency. Toothpaste, shampoo, and general hygiene products do not qualify. Routine personal hygiene is not medical care. Baby formula and diapers do not qualify. Classified as general childcare expenses. Cosmetic procedures, Botox, fillers, aesthetic treatments do not qualify under any circumstances. The practical rule is simple. If you are not certain an item qualifies, do not buy it. A rejected claim is more costly than a small forfeiture. The right action depends on how much you actually have remaining. Here is a clear plan for each level. $50 to $200, one organized shopping trip closes it. A 12-month supply of OTC medications plus sunscreen and first aid supplies covers this range in a single visit. $200 to $500. Schedule one dental or vision appointment before your deadline and combine it with an OTC stock-up run. 2 actions close this range. $500 to $1,000. A combination approach is needed. A dental cleaning plus one device purchase, prescription glasses, a blood pressure monitor, or replacement CPAP supplies, absorbs this range. Book 2 appointments if scheduling allows. Over $1,000 remaining, immediate action across multiple categories is required. Contact your physician about a letter of medical necessity for any gray area qualifying expense. Book multiple appointments. Purchase all devices and supplies you legitimately need. At over $1,000 remaining, do not wait. Every day of delay reduces available options and increases the risk that appointments cannot be scheduled before your deadline arrives. If your plan offers a grace period or carryover, your strategy adjusts, but urgency does not disappear. For grace period plans, your deadline extends to March 15th. Use December for highest priority spending. Use January through March for appointments harder to schedule on short notice. Book dental and vision in January while availability is good. Track your balance weekly from January 1st and treat March 15th with the same discipline as December 31st. For carryover plans, the math changes specifically. Your goal is to spend everything above $680 by December 31st. The bottom $680 carries into next year. You do not need to spend that portion. Calculate precisely what sits above the threshold and spend only that amount intentionally. Carry those funds into January and deploy them on your first predictable expense of the new plan year. The most common carryover mistake is treating the $680 as guaranteed and then forgetting it in January. Set a calendar reminder to use carryover funds first before new contributions begin to accumulate. Missing it in the new year is the same loss repeated. Everything covered so far is reactive. The better outcome is preventing the problem entirely through a year-round system. At open enrollment, estimate contributions carefully. Confirm your deadline structure. Contribute slightly below your projected spending rather than at or above it. In January, confirm your opening balance. Schedule first quarter appointments while availability is good. Set a recurring monthly calendar reminder to check your balance. In April, run a mid-year check. Review your balance against spending so far. If running ahead, you have months to add eligible purchases naturally. In September, run an early warning review. Calculate remaining balance against months left. If a gap exists, 3 months remain to address it without any urgency. In November, begin the final approach. Identify your exact spending gap. Book appointments. Plan your OTC stock-up. Organize preparation, not panic. In December, execute. Spend on eligible items only. 0 forfeiture through a plan that has been building since January. 1 monthly reminder. 6 intentional check-ins per year. The entire December problem solved permanently at the January level where it actually belongs. The root cause of most FSA forfeiture is not failing to spend in time. It is contributing the wrong amount at open enrollment. Over-contributing creates a structural problem no year-end strategy fully solves. Step 1. List every predictable medical expense before enrollment closes. In writing, every category you can anticipate with reasonable confidence. Step 2. Add them up. Prescriptions multiplied by 12 months. 2 dental cleanings plus any anticipated procedures. 1 vision exam plus lenses or glasses. Copayments based on your typical visit frequency. Step 3. Add a buffer of $200 to $300 for unexpected expenses. 1 urgent care visit. 1 unplanned prescription. These happen in most years. Step 4. If your plan offers carryover, subtract up to $680 you expect to carry forward. You do not need to refund that portion. Step 5. Contribute at or slightly below this total. Slight underfunding is less costly than forfeiture. Step 6. Check IRS Publication 502 before finalizing. The eligible expense list has changed before and may change again. 6 things you now know clearly. First, Americans forfeit $3 billion in FSA funds every year. Every dollar is preventable with the right information applied at the right time. Second, know your deadline structure before doing anything else. Hard cutoff, grace period, or carryover. That single answer determines your entire strategy. Third, calculate your exact spend target before purchasing anything. Balance minus known expenses minus carryover allowance. Spend to that number precisely. Fourth, 3 legitimate categories cover any remaining balance. OTC medications and health supplies for stock-up spending. Medical appointments for high-value spending. Devices and equipment for single-purchase balance absorption. Fifth, panic spending on ineligible items produces rejected claims and compliance action. If you are uncertain whether something qualifies, do not buy it. The ineligible list is firm. Sixth, the year-round system eliminates this problem permanently. A monthly balance check and a September warning review make December stress-free every year. The money was always available. The eligible expenses were always there. The only missing ingredient was the information to use both correctly, and now you have it. That is the complete FSA year-end survival guide for 2026. Your deadline structure, your spend target, your eligible categories, your prevention system, everything you need to keep every dollar you earned. If this gave you a clear plan for money you already have, subscribe to Gold Cipher. New financial intelligence breakdown every week. Where serious money begins.